Good afternoon, ladies and gentlemen. My name is Michalis, and I'm one of the market analysts here at HF Markets. Most people probably watching today's webinar know me already very well. I've been a market analyst for 6 years. I originally started off as a financial advisor, so people have known me in the market now for a very long time, just over 10 years actually. Today we're going to be looking at strategies. We're going to be looking at a specific strategy that we looked at approximately 3 to 4 weeks ago on a different webinar. We had such great feedback, and it's so great to see people sending me messages, emails. We actually had one person who said their success rate actually increased by almost 100%. Which is amazing to hear. So really great to hear some feedback. It's much appreciated. I'm glad strategies like these can be helpful. Today, though, we're looking not at the strategy again and looking at the strategy, should we say, in more detail, but what we're actually looking to do is to look at the entries and the exits. So how we can use certain indicators and certain setups in order to obtain as traders indications that at this price, at this time, with this target, we are entering into the market, speculating in a specific direction. So this is what we're going to look at today, because last time when we looked at this strategy, we looked at a lot of different aspects. We looked at the strategy in a lot of detail. Today, we're not going to look at that again, but what we're going to look at, which to be honest, probably one of the most should we say, interesting factors and parts of strategies is to look at how you can use it instantly. So not something that you need to take a lot of consideration and look at a lot of research and so on and so forth, but something that you can actually instantly start to take into consideration. How to use these strategies to obtain signals of entering buys, entering sells, within a certain period of time, and also with certain targets. So we're not only looking at how to enter, but also things that we need to take into consideration to actually exit the market as well. Now, we had a lot of questions. I probably answered something like 5 questions before the webinar started. It's great that people have a lot of questions. Of course, I advise everybody to ask as many questions as they like, because these webinars, yes, we are looking at a presentation, but they're good opportunities for you to ask questions about the market. Today, we've had a lot of questions before the webinar even started. It's understandable because we have had such an amazing and interesting release. We actually wrote about the release in this morning's market analysis, and we did state that there is a possibility that inflation was going to read higher, and we stated exactly what kind of effect that was going to happen on the market. Anybody that read that this morning would have seen exactly what we said, exactly what I wrote happened within the market. So this is also the importance of actually reading the articles, which come out approximately about 8:30 GMT. Now, very quickly to let everybody know, because people send private messages on the GoToWebinar software with questions. We actually had one question, ladies and gentlemen. Somebody asked, I'm seeing a lot of volatility on the DAX. Why is a US announcement having an effect on a German-based index? Which I actually think is a great question. And the answer to this, ladies and gentlemen, is that this announcement, the CPI announcement, so inflation and core inflation, which read higher than expected, inflation in the US has actually increased to the highest level in 6 months, whereas actually we should be looking at the opposite domino effect within inflation, very simply because we're looking at an ultra restrictive monetary policy at the moment. So the reason why we're seeing this volatility and declines in European equities, not just the DAX, is very simply because when you see inflation increase, we get a lower investor sentiment towards equities. This is point number 1, and people should take into consideration when there's lower sentiment within the global financial trading markets towards a specific category. A lot of the time, it's not just going to be against one stock, or should we say, 5 to 10 stocks, but it tends to be a lot of the time something seen and witnessed across the market as a whole, so including Asian and including European and UK indices as well. Of course, certain, should we say, regions have stronger correlations, which we won't look at the moment. For example, the European and US have slightly stronger correlations than, for example, Asia, but nonetheless, they are correlated. The other thing for us to take into consideration is that, of course, if the Federal Reserve are going to become more hawkish and delay adjustments, and not only delay adjustments, but actually reduce the number of interest rate cuts in 2024, then it can have a domino effect on other central banks as well. So, for example, tomorrow we have the European Central Bank. So now, is the European Central Bank going to take a harder, more hawkish stance within the market? Because if it does, then again, that has a negative effect on European stocks, including the DAX, including the CAC, and so on and so forth. Now, I'm not going to go through all the questions, ladies and gentlemen, because I had approximately 6 questions before the webinar even started. I've answered all of them. If people have more questions, then they, of course, can ask as many questions as they like. I will stop the webinar, I'll read the question out, and I'll answer it as quickly as possible. Now, before we get started at looking at today's strategy, looking at today's topic, looking at entries and exits, very quickly, I want to do just 2 slides of a quick introduction. Now, today's volatility was very strong. It was more or less in one direction. So a lot of people today probably could have thought, okay, that's easy. It's a lot of volatility. It's in one direction in a short period of time, in 15 minutes or 30 minutes or 1 hour, whatever it may be, I've made a lot of money. So trading is easy. People need to understand that when we're looking at investments, there is always a risk to the capital that we are investing. It's important to manage that, to mitigate it, of course. We are going to be looking at those factors today as well. The investment and the risk is fully in your control and in regards to your setup as well. So we have no control over how certain assets and the volatility is going to move. If you look at, for example, Google and check the price movements of the NASDAQ and the DAX and currency exchanges, you will see that our platform 100% mitigates what is available in the financial trading market. So we have no control over that. So it's important to take steps to ensure that you are trading responsibly and safely, okay? And that way it's a more enjoyable and more successful experience for you as well. Because of course, what we want to do is, yes, we cannot give investment advice. We're not here to give investment advice. Somebody is looking for a financial advisor. They're more than welcome to do so. There's plenty out there. But these webinars are not here to give advice. They're here to give as much educational material as possible in order for you to ensure that you can trade in the financial trading markets with knowledge, with expertise, and with confidence as well. Because what we want is everybody, of course, to be successful, not only successful, but consecutively successful as well. This is the last slide, and we'll go straight into looking at aspects that we need to take into consideration. So a bit about my background. It's not important to you as a trader. It's not important to today's strategy. It is, though, important to know a bit about the individual that is providing you with this information. I just want to spend just a couple of seconds going through this. I've been in the financial trading market for 10 years now. I originally was a financial advisor in London. I've been a market analyst for 6 years now. And I do hold 2 licenses. I hold a UK-based license and an EU-based license. Like I said, it's not important to your trading, to today's topic, but what I want people is to understand that it's a great opportunity to have these live webinars. You can ask questions. If you have something which you're struggling with in the financial trading market, then of course you can get into contact with me as part of these sessions, and we can make sure that you have all the relevant answers and the information accessible to you. So the first thing I wanted to say is, because also I've been looking at all these one-on-one sessions that I have been having with traders over the past few months. And I always tend to see when we're looking at, okay, it's not an issue so much when somebody has experience of, let's say, 6 months, or the sessions which I have with more experienced traders. But with beginners, it's a bad habit that I tend to see a lot of the time. And I wanted to mention these habits very quickly to everybody before we start looking at today's strategy. So it's always, as a beginner, they tend to have a habit, the bad habit of when something becomes extremely expensive. Now, when I say it's expensive, it may be at a resistance point, it may be at a significant psychological level in the market, it may be, even if you've got somebody using more advanced tools such as volume profiles, it may be at a very significant level in the volume profile, whatever it may be. When the price is extremely expensive, beginners tend to have that bad habit of straight away having the bias that that asset is going to decrease in value. Now, I want some people to just take the time to look at, for example, the NASDAQ in 2023, to look at, for example, gold in 2024. Also in 2024, you can look at things like European defensive stocks, which we spoke about earlier on today as well. You can see that when something becomes extremely expensive, it doesn't mean that it's going to decline. So a lot of the time, beginners get into a habit of when something is extremely expensive, it's going to decline back to the previous price. Or when something is too cheap, if it's declined to its lowest level ever seen, for example, the lowest level in 10 years, then it's trading below its intrinsic value. So I'm going to buy. Now, this, ladies and gentlemen, okay, it's good to look at the price and trying to think about what the true value is of the asset. For example, people look at stock ratios, people look at different factors to determine if the stock or if the asset is at its true value. That's not a bad thing for people to do. And the fact that as beginners, we're looking at that and taking it into consideration is a good thing. But what beginners do is something becomes extremely cheap because it's collapsed in terms of the price, and they automatically have that sentiment and that emotion and don't have the discipline, should we say, and they go straight onto the platform and click buy because they say at some point it's going to increase in value. And there's a couple of things that people need to take into consideration. Number one, if something's declining in value, you really need to think about why is it declining in value. There's a reason that people are not buying it, and there's a reason that shareholders, for example, if it's a stock, are dumping their shares. So it may not be a good idea, without taking anything else into consideration, to go straight away and buy. The other thing for us to take into consideration is we're trading with leverage, which actually means that volatility is extremely important. So there's no point buying now and saying in 6 months' time the price is going to increase in value. What we need to determine as analysts and as traders, and we're going to look at that today, is not only to say I'm going to buy at this price and this is where I believe the price is going to go. What we need to do is say, yes, I'm going to buy at this price. Yes, this is where I believe the price is going to go, but within this period of time. This is how you're going to increase your success rates as a trader and also become better at evaluating the price movement of an asset. So for example, here, ladies and gentlemen, we're looking at the price of gold. So what a lot of beginner traders do, and also I'd like to point out that we're going to speak about this later on, but also investors that are just entering the market tend to have the bad habit of, as soon as something moves into a little bit of a profit, they close it because they want to finalize that profit and remove the risk of losing that profit, which isn't necessarily a bad thing. This is kind of the approach of scalpers and ultra short-term traders. So it's not a bad thing, but what they do at the same time is simultaneously they're keeping losing trades open for longer. So one losing trade may eat away the profit of 5 or 10 or 15 or 20 trades in a profit. So it's always important to ensure that, yes, when you're trading, and you're in a profit and you wish to close the trade, it's absolutely fine. But make sure when you're risking, it's responsible and it's at the appropriate level in comparison to your take profits. I can see a question. I will answer the question in a couple of minutes. It's just somebody saying great webinar so far. So thank you. So I'll carry on. So we really need to think about that as well. But what a lot of beginner traders do is, they'll say the price is extremely high here, so I'm going to speculate a decline. And then it keeps on going up, and they say, it's really high now, so definitely now is the point to sell. And then it keeps increasing and do it again and again. And then what actually happens is you've got 1, 2, 3 trades in a loss, and maybe your account cannot withstand that volatility. So if something is trending, there is less, should we say, risk to a certain aspect, to a certain extent, sorry. There's less risk to that when you're trading in the direction of the trend and in the direction of order flow, rather than actually speculating against everybody in the market. Because if it's you against everybody else in the market, you will lose. Now, if you think something is too expensive or overpriced or trading above its equilibrium price, then of course you can speculate a decline. But what you want to do, actually what we do have is a poll, ladies and gentlemen. I'll quickly release this poll. So I've just launched this poll, ladies and gentlemen. So everybody will be able to see the question. If you think an asset is trading above its true value, okay, what is it that you need to do? So everybody, if they quickly answer the poll, and then we'll continue. So the options are, and I can see most people are starting to vote. I can see most people are voting the correct answer. Some people are not though. So we'll look at that in a minute. So option number 1, instantly trade and speculate that the price is going to decline when you think something is too expensive. Or the other one is wait for a relevant signal. So I'll give 5 more seconds. 1, 2, 3, 4, 5. So I can see 73% of the viewers have answered. We've got 80%, just over actually 80% answered wait for a relevant signal. That is the correct answer, ladies and gentlemen. And we've got some people that said instantly trade. So it's always important to wait for the relevant signal. Yes, okay, you have that sentiment, you've come to that conclusion that the price is overpriced, but wait for a signal and wait for the appropriate price action to speculate the decline. Now, before we start to look at the strategy, this is the last slide, and then we'll go straight on to charts. There are recent examples. I've even got some examples from today's today's live platform, just approximately about 50 minutes ago. So I wanted to give examples from today, but I wanted to give past examples as well. But before we do that, it is always important to also look at fundamental analysis. Now, people always say to me, especially more advanced and professional, should we say experienced traders, they say to me a lot of the time, should I be looking at more advanced analysis like order flow analysis? We're not going to be looking at order flow today, but you can type in on Google and do your own research and look at order flow analysis. Some people say fundamental, some people say technical. And to be honest, it's very important to be using aspects of all three because all of them have their limits and all of them have their advantages as well. So for example, you cannot trade solely based on fundamental analysis if you're following what is traditionally known within the market, because something may be released which may support an increase, and maybe yes, over the next 6 months it does increase, but at that moment it's actually going to decline. So if you're not looking at technical analysis, you're going to be trading in the wrong direction of the market, even though your analysis for the longer term may be correct. So it's always beneficial, and there's advantages to using all three, at least aspects of all three. So these are very easy setups, Okay, it's just a checklist of 5 points that you can do every day, no matter your experience and your knowledge, to really help you build a bias for the day or build a bias for the week. Now, what do I mean a bias? When I'm saying a bias is having a bias of whether we're looking at a bullish market or a bearish market, whether buyers are controlling the market or sellers are controlling, or whether there's a high risk appetite or low risk appetite in the market. Now, point number one, keep in mind, most people on our platform trade indices, a very, very high percentage trade indices. If you're not trading indices though, then point number one is going to be something which is not applicable to you. But if you are, then this is something extremely important. So point number one, components. Now, everybody knows that indices are grouped stocks which have been pulled into one fund, one asset. So it's multiple stocks within one asset with one price. Now, there's two ways it can be priced. It can be priced either based on the price of each stock. So the more expensive stocks are more influential, okay, so they're more important, or it could be based on the weighted method. It's known as the market weighted method. For example, the NASDAQ, the S&P 500, they're based on the weighted method, whereas the Nikkei 225 and also the Dow Jones is not. Now, what is components and checking components and component analysis? I actually will show you this at the end of the webinar. We'll go on Google and I'll show you exactly how you can find it. But what it is actually doing is when you're trading within the market, you can access the performance of each stock in one page. Okay, so you can look at all of the stocks at the same time. So for example, the Dow Jones, all 30 at the same time, and look at it and see the individual performance. So yes, for example, the Dow Jones may be increasing in value, but if you look at the components, actually only 40% of the components are increasing in value. So yes, the Dow Jones is increasing in value. Yes, maybe the most influential stocks are increasing in value, but actually 70% of the fund is decreasing in value. So most people will be slightly concerned about that. I can see another question. I will answer the question, of course, in a couple of minutes. So you can look at each day the component and align it with your strategy and align it with your indications. So for example, if you have indications the price is going to increase and you go to the NASDAQ, for example, and you can see from the NASDAQ, 80% of the stocks are increasing in value today, then of course you have no conflicting signals. You can see there's great sentiment in the market, the performance of the market is extremely well, and at the same time you've got signals to buy. So they're going hand in hand, they're not conflicting. Because of that, you've got a good bias of the day that prices potentially can increase in value. The other thing is order flow. Order flow reports, most of the time order flow reports are available on the US Futures Commodity Trading Commission. They release most of the time every single Friday, and they basically confirm how many more buyers were there in the market and how many more sellers there were in the market. So for example, if you're seeing gold increasing in value for 3 weeks, and for 3 weeks, each week you can see there's less and less and less buyers, then you can take that into consideration now. You know, yes, it's still increasing in value, but there's actually less buyers. So is it losing momentum? Are people becoming less interested? Is it too expensive? So again, this is also something you can take into consideration. It's not just for commodities, by the way. You can also see that with equities. Whereas when you're looking at currencies, it's less influential, it's more difficult to use it as part of analysis. Bonds, US bonds, specifically the 10-year treasury bills. Ladies and gentlemen, bond yields are increasing in value, it's negative for the stock market. If they're decreasing in value, it's positive for the stock market. Very simply because if they're increasing in value, the cost of debt is more expensive, which is bad for everybody, which is why stocks decline. And also, in addition to this, we have to take into consideration that bonds actually become more attractive because they're given more profit. So people become less interested in stocks and become more interested in bonds, which is why it pressures the stock market. So this is something we can take into consideration. The US dollar index, this is something you can use not only for stocks, but also for currencies. So for example, if you're investing in the Euro USD and you're speculating the Euro USD is going to decline, so the dollar is going to increase in value, but actually the US dollar against the rest of the market is decreasing in value, it's only increasing in value against the euro, you'd probably be less comfortable using that to speculate the decline of the euro. Ideally, you want one currency increasing in value against the whole of the market and the other currency decreasing in value against the whole of the market, rather than the currency experiencing what is known as a tug of war scenario. Okay, so you can use not only just the US dollar index, but currency indexes in general. Global stock market performance. If the Nasdaq is increasing in value, but the stock market again in the rest of the world is collapsing, most likely you're not going to be very comfortable speculating that it's going to continue increasing. So let's, ladies and gentlemen, start also looking at strategy. I can see a lot of comments. People saying, is it this strategy that we looked at? Is it this strategy that we looked at? It was a great strategy. Please just look at this again. I'm not sure, people don't actually tell me the name of the strategy. They're just saying, was it this strategy that we once looked at? But the main thing is that I can see people got great results from it, and that's the main thing. But I'm not sure if it's that strategy that you guys are referring to. I've got another question here. I'll quickly answer this. So somebody said, why the news looks good for the currency, but the pairs, so the currency pair, actually makes a different type of price movement. So to say in a simple term, should we say, if the news is good, why does actually price decline? This isn't something unusual within the market. We have to realize that the price is going to be driven based on buys and sells. Now, the idea of the fact that when there's good news, the stock should, or the assets should increase in value, that is the theory, but sometimes there's good news, but people don't go straight away and buy. They may, wait for it to decline, to a better price, and then go and buy. So for example, if you get a pay rise, yes, probably you're going to start spending more, but it doesn't necessarily mean in that second, in that hour, you straight away will go online and start buying everything. So we really need to think about investor sentiment. It's not always so straightforward that they're going to go straight away and buy. The other thing is we always have to consider there's always pending orders within the market. If somebody's using the depth of market and the order flow, they'll be able to see the pending orders. So for example, the price may be doing something like this. A lot of the time before news, it starts to move sideways. We definitely saw that today. And what happens is at this price here, there's actually pending orders to sell. So if the price increases like that, it just collapses after that, like this. So this is also another reason why sometimes we get good news or bad news, but the price movement's actually in the opposite direction. I've got another question. I'll quickly will answer this. By the way, that gentleman that answered that question says this happens quite a lot. If you think it happens quite a lot, you should do the exact opposite as to follow the theory. But to be honest, if you're using what we're looking at today and not solely trading based on news, and you're actually using a strategy, it's not going to be an issue for you at all, because the strategy will confirm the right direction for you. So don't forget to drop your social media, teach. Somebody said that if I can drop my social media, of course you can access me on LinkedIn. You can follow me within the company as well. Of course, at the end of the webinar, I will confirm to everybody my full name as well. But it's not necessarily important to the topic. So let's carry on and we'll get back to this. But again, thanks for the positive vibe. So the strategy. So what I've done is I've taken, because the last time we looked at the strategy, we spent about an hour. Today, well, we're not going to spend more than an hour, hopefully. But we spent about an hour and 15 minutes. And we looked at it in a lot of depth, and we looked at a lot of different factors. And sometimes when you look at it too much and too much in depth, then what actually happens is it becomes too difficult for you to start using it by yourself. So what I've actually done is I've removed a lot of different things from the strategy and just kept the key factors to ensure that people are able to actually start to use it today and make it as simple as possible, in not less accurate, keep that in mind, not less accurate, but to get the main factors to ensure that they're able to use it to obtain signals. Now, on the on the chart at the moment, we're looking at the DAX, which is a German-based index, includes 40 German-based stocks. Not important for the moment. Let's look at what indications we're looking at. It's a 2-hour time frame. We always use this setup on the 2-hour time frame. Then we will switch onto a 5-minute time frame, because the idea for the 2-hour time frame is to establish 3 things. We want to establish the impulse and corrective waves are forming the right formations. We want to establish that sellers are either buyers or sellers are controlling the market. And we also want to establish that there's either a strong or a weak sentiment towards the assets as well, and towards the price. Now, in order to establish that, we have here a line. Now, this line, ladies and gentlemen, is a 75 bar, so a period of 75, and it's an exponential moving average, ladies and gentlemen. Ignore my handwriting, I know it's terrible. It's not actually that bad in real life, it's just that I'm using a computer mouse. Then at the very bottom here as well, we have a relative strength index, also known as an RSI. It is on a period of 18. I know a lot of people are going to say to me, that's extremely high, but keep in mind, we're using these indications for price sentiment, buyer seller control within the market, and wave formations as well. We're not necessarily solely using it for ultra short term overbought and oversold, which is really simple ways of using it. We want to take it slightly further. But what you can see is I'm only using 2 indications. I'm not looking at something extremely advanced. Now, when we look and speculate the price is going to increase, we want to be looking at the price when it's above, and we want to ensure that the RSI is between the 50 and 75. If it's between the 50 and 75, it indicates that buyers are controlling the market. If it's above 75, it's too expensive. Doesn't mean it's going to collapse, but it means there's a heightened risk of a different type of movement. That could be a collapse, but it could just be a retracement, it could be a correction. If it's between 50 and 25, it means sellers are controlling. If it's below 25, it's too cheap. So there's again a heightened risk for that. Now, we always want to ensure that the RSI and also the 75 bar exponential moving average are not conflicting. We want them to be indicating the same direction of the market. So for example, in this area here of the market, this whole area here, so we're looking at a period here, ladies and gentlemen, we're looking at weeks, we're looking at almost 3 weeks, ladies and gentlemen, of indications that the price is going to increase in value. We can see we're not getting conflicting signals. The signal is always that the price is going to increase in value. And even before we switch onto the 5-minute, to be honest with you, looking at this, it's just moving upwards. So just this setup alone is helping us a lot. Very clear indications of strong price sentiment and buyers are controlling the market. Now, in that region, ladies and gentlemen, yes, we're getting declines. So here there's a decline, here there's a decline, here there's a decline. There's small declines a lot of the time. It doesn't mean when the price is above and indicated buyers are controlling, doesn't mean that the price is never going to decrease. there's still volatility, there's still bullish and corrective waves. We need those bullish and corrective waves. We need that volatility. A lot of the time people think, oh my God, the price is declining. That's a bad thing. When the price declines, it's not necessarily a bad thing, ladies and gentlemen. It's just giving you an opportunity to enter at a more competitive price. If somebody says to you, for example, would you like to buy, should we say, this phone for $1,000, and then the next day they come and say to you, would you like to buy it for $900? You would be happy, you wouldn't be sad. So volatility is good, okay? So what we do though need to look at is that when we're getting indications of the 2 hours that the price is going to increase on this trend line, on the oscillator, so the RSI, we are ideally looking at where there's potential that the price is going to increase and not where there's potential that the price is going to decrease. Now, I'm not going to look at this area here, okay? It will be so easy for me to look at this area here because it's a very large, a lot of volatility, long period of time as well. So it's easy to speculate that, easy to trade there. I don't want to look at that. I'm actually going to look at the hardest movement, and I'm going to look at this signal here, this area of the market here, because it only moved in our direction for 6 to 8 hours after we got that signal. So I'm not going to look at the easiest signal. I'm going to look at the most difficult signal here that we can see. Okay, so this is an area of the market at this circle here, where people will be saying, let's switch now to 5 minutes because we can see the market has slightly changed. And we're going to start now to look at where there's opportunity to speculate a decline. Doesn't mean we instantly go and click the button sell before thinking about anything else. No, we're now getting indications that sellers are controlling because we're below the 75 by exponential moving average, and we're between also the 25 and 50, which is also another indication. So both indications are indicating a decline. And we can also see that when we're looking at also wave analysis, as well as on the price itself, and also on the RSI, we can see we're looking at lower lows and lower highs as well. So everything here, ladies and gentlemen, all three aspects are indicating the decline. We switch now onto a smaller time frame. Here is a 5 minute time frame. And by the way, guys, let's go back here for a moment. Here you can see the date, 4th of April, 8 o'clock. You see the next time frame here on this chart, 4th of April, 8 o'clock. I'm looking at the exact same price movement. So what am I doing? Here now I've got different indications. Here I've got a MACD, okay? And I've got this yellow line here, which is an 8-bar exponential moving average. Okay, so it's an period 8 moving average. And then I've got the red here, which is an 18, and it's a simple moving average. Okay, so I've got two moving averages now, and I've got the MACD as well. Now, point number one, there's two ways we can look at this. And I'll confirm exactly if there's more benefits to the first way or more benefits to the second way. We have to know both, all right? So way number one, we've already got a signal on this line here. This is on this line here is where we start to get a signal the price is going to decrease. Once we get that signal, as soon as we get the yellow, which is the 8-bar, cross below the red, which is the 18-bar, this is a bullish crossover. As soon as we get that, that is a speculation that the price is going to decrease, okay? Now, if we look at the MACD as well, also in addition to that, the price is trading, so the MACD is trading in the negative zone as well. So we can see not higher bars like here, but we start to actually move on to the negative side. So this is also another positive thing indicating downward price movement. So point number one, option number one, we wait for the bearish crossover. So we can see the bearish crossover, the yellow crosses over downwards. Then what do we do at that point? We look at the previous low. So the previous low is here, ladies and gentlemen. So you can see this is the high, and this is the low here. So you can see I've drawn very simply a line at that low. As soon as the price drops below that low, we can use that to speculate the decline, okay? If you did trade at that level, you can see there is a lot of price movement. So we can see that, ladies and gentlemen, very successful trade based on this example here. So this is point number one, okay? This is one option. We wait for the bearish crossover on the 5-minute time frame, and then we wait for it to cross below the previous low. Previous low, ladies and gentlemen, the most recent previous low, keep that in mind. So I'm not looking at this low here, I'm looking at the most recent low. So it's this area of the market here, ladies and gentlemen. Next option, okay? The next option, ladies and gentlemen, you can look at the most recent wave. So the most recent impulse wave, so not corrective wave, so impulse wave, is this all the way up to here. So this is the most recent wave here. What you can do, ladies and gentlemen, is use the Fibonacci retracement. So you can basically draw the Fibonacci between these 2 points and it'll come up with these lines automatically for you. If you don't know how to do that, I of course can show you at the end on the MT5. And what you can do is wait for the price to break below 61. As soon as it breaks below 61.8, then that's it is an indication that the price is going to decline. Again, either if you looked at option number one or option number two, this was definitely a profitable trade. And the great thing is, at no point did this trade go into a minus. So this is a great scenario. Also, it's important, we're looking at the 5 minutes to speculate a decline, yes, okay, but at the same time, it's still on the 2 hour, also indicating a decline. So we're not here looking at a buy, and on a smaller time frame, looking at a sell. So we're not looking at conflicting signals. We are looking at signals which are indicating the same direction of the market. Let's look at another example. So here again, we're looking at a 2 hour. You can see I'm only using this setup on the 2 hour. Now, if we're going to change that and look at, for example, 3 hour, 4 hour, or 1 hour, it's not a bad thing, but the setup will have to change. The periods will have to change, or needs to change a lot. So keep that in mind. If you're going to change the time frame, everything else will change as well. So this and these periods are based on this time frame. Also, keep in mind if the asset that you're looking at is very different in terms of volatility to, for example, the assets we're looking at the moment, then again, the period may slightly need to change. Now we're looking at the Dow Jones. The Dow Jones, ladies and gentlemen, you can see we've been getting indications that the price is going to decline since the 1st of April. So we've been looking at indications of a decline since the 1st of April, and generally speaking, it has been declining for 10 days. Yes, there has been days where it traces and increases, but overall, been declining for 10 days. Also gain momentum after today's news as well, because today's news, we're looking at higher inflation. It's at a 6-month high. It lowers consumer demand. It lowers investor sentiment. Equities become less attractive because other assets such as fixed deposits, such as the dollar, actually, and also bonds as well, actually become more attractive. So it's really fueling the demand, the decline as well. But if we ignore that, just for the moment, we can see here, ladies and gentlemen, we're definitely trading below the 75 bar exponential moving average. We're definitely trading below the 50 as well. So the 50 is a neutral. The area which is speculating that sellers are controlling the market, and there's, should we say, a more cautious approach towards the Dow Jones, is where it's trading between the 25 and the 50. So here we can see definitely areas and indications that the price is going to decline. Now, what people can also do, and this is actually something that we looked at when we looked at strategy 4 weeks ago, what people can do, and I've taken this out because, like I said, I want it to be as simple as possible, but what people can do is they can actually start to measure all of these corrective waves, okay? And what they can do is measure these impulse waves. And what they can do is they can get a good idea of every time it moves in a certain direction, traditionally, how far and how strong is the movement. Because if traditionally, or should we say on average, it's going to decline by 1%, and at the moment it's declining by, let's say, 1% or 1.10%, then as a trader, I'm starting to think, okay, this is now the point when actually we tend to get a different price movement in the market. So definitely this is something we also need to actually take into consideration. It is slightly advanced, more advanced than keeping it super basic, but you can take it into consideration. So for example, if you look at this retracement here, and then we look at this retracement here, the size is very, very small, okay? So this gave us an indication that actually it was going to lose momentum and start to move back down. Unless we were going to get a different outcome from today's inflation report, which we definitely did not get. So at the moment, including measurements and wave analysis, because we can see low, 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 lower, lower, and lower. Everything is pointing towards a decline. Nothing conflicting there. Then we go on to the 5-minute time frame. You can see I put a line here as well, so everybody can see I'm not looking at a different day, not looking at a different chart or different time, exact same time, okay? So here, ladies and gentlemen, we're doing the exact same thing. We want to see a downward crossover. Why? Because we want an indication the price is going to decline, because that's what we saw on the 2-hour. So 2 options again. We can use both options, okay? It's not an issue. We can use both options. Option number 1, we wait for the bearish crossover. We ignore this bullish crossover. This bullish crossover is no good for us. Why? Because it's indicating the opposite of the indication that we were actually getting on the 2-hour. So somebody was trading this. To be honest, it's a large enough price movement for it to be successful. So to be honest, that signal wasn't a bad signal, I would say. But you can see it was actually a decline before it and there was a decline after it. So if your timing wasn't great, it would have been a difficult trade. Whereas here, we're trading in the direction of the overall price movement, which is ideally what we want to see. Because if your timing is not accurate, the market will be less forgiving if you're trading in the direction of the trend. So option number 1, we wait for the bearish crossover. So the yellow, the 8 bar to cross below the red, which is the 18 bar moving average. So here we get a crossover. This is the most recent low, or you can actually use this low here, ladies and gentlemen, to speculate the decline. So even if we cross below here, ladies and gentlemen, we can see the price does continue to decline. So this is option number 1. Option number 2 as well is we can use the Fibonacci. On this occasion, we can see the Fibonacci gives us more earlier entry. So of course, it's a better entry. But nonetheless, you can, ladies and gentlemen, you can cross over the most recent low, which is this low here, and trade there. That's absolutely fine. That's not an issue. The other option now is, of course, we've drawn the Fibonacci retracements from the low to the high. We want to use the breakout of the 61.8 to trade downward price movement. Okay, so you would have actually entered here. After that, we saw some price movement against us. Very, very small price movement. We didn't go on to a higher high. We didn't go to the 0 on the Fibonacci. I mean, if we look at the Fibonacci 0 point, the distance is 0.05. So it's a very, very small distance. So that very small movement against us for about 15 minutes, it's not an issue in any way, shape, or form. And you can see since then, the price movement is definitely trading in the direction of decline. So again, this is another very accurate indication that the price is going to decline. Let's look at another example. This time we look at an example from approximately an hour ago, still the Dow Jones, but the same applies actually for the Nasdaq and every other asset as well. So nothing's changing there, ladies and gentlemen. We can see here the prices very clearly still having lower lows, lower highs, very clearly as well, still below the 75-hour exponential and below 50 and above 25. So all indications are still indicating a decline. What we do, switch on to go to a 5-minute time frame. We can see the 5-minute time frame here. We've got our Fibonacci retracements between the low and the high. The breakout is here, ladies and gentlemen, 61.8. And you can see since the 61.8, we're seeing a very, very strong decline as well. So the 61.8 is where we want to trade. Now, if you're late, okay, the signal was 10 minutes ago and we've already moved substantially away from that price, or if it was an hour ago, whatever. If you're late, it's not an accurate signal. It's not an active signal. You're too late, ignore it, don't risk it, okay? So when you get a breakout, it's at this level to trade. You're not trading up here and you're not trading down here. It's too late or too early. At the breakout, okay? So keep that in mind. And again, you'll see we're always switching between the 2-hour and the 5 minutes. The only reason here I put a 15-minute, ladies and gentlemen, is because there was so much volatility that actually this wave here wasn't visible. Okay, so that's the only reason I had 15 minutes, so it's more visible to you. Nonetheless, you would have been using the 5 minutes. So the last thing people I want to understand, okay? We're actually going to do another poll here. This is the last thing that we're going to speak about before ending today's webinar. We're going to launch a poll. So is it true that even an unsuccessful trader can be profitable? Okay. What do I mean by that? An unsuccessful trader is somebody that has a low success rate. So for example, if he's trading 10 trades a week, less than 5 of those trades are successful. Okay, so he has a low success rate. Can somebody with a low success rate still be profitable? This is actually one of the most important things. It's actually more important than actually strategy. Okay, so we're going to spend only 3 slides looking at this. I'll give people 10 more seconds to answer. Some people are answering correct, some people are not answering correctly. Just 3 more seconds. Okay, let's close it there. So actually, at the very beginning, 51% of people voted. At the very beginning, ladies and gentlemen, we had about 60% only vote the correct answer. But that grew happily, so I'm glad about that. 85% answered correctly, 15% answered incorrectly. The answer is true. Even if you're unsuccessfully able to determine how the market is going to move within the market, you can still be profitable. What do I mean by that? Even if every 10 trades that you're opening, only 3 of those trades are profitable. If you're setting up the mathematics and the statistics behind your trading, such as the reward to risk ratio, such as in actual terms of capital, okay, what your target is and what your risk is, if you're setting that up in accordance to your success rate, you can still be profitable, even though you are unable to accurately determine how the market is going to move within a certain period of time. So I'll give you an example. Now, this is an example based on a trader. It's none of you guys, by the way. It's not somebody specific. It's just something set up as an example by me, which is traditionally something that we see by beginner traders. So traditionally, beginner traders, they don't open, a lot of trades. They're not going to open 50, 60, 70 or 100 trades within their first week. And most likely in their first week, they probably won't have a very large percentage of their trades closed in a profit. Okay, it's understandable. It's not a bad thing. It's not a bad thing at all. What we do want to make sure, though, is that regardless of that, the trade is still profitable. That's what we want to ensure. Okay, this is why I say, yes, the strategy we looked at is important. It's important everything else we spoke about, like such as the bad habits, also such as, for example, building the bias of the day, etc. But this is something extremely important, which is why I always look at it at least 2 times a month. Okay, so here we can see somebody's opening 10 trades. From those 10 trades, he closes all of his trades. He doesn't keep anything running. He closes all of his trades because he's a trader. He's not building a portfolio, in which case he keeps it running forever and ever. He's come to the end of the week. It's the weekend now, and he's reviewing his trades. He closed 4 in a profit. He closed 6 in a loss. Okay, so he has a 40% success rate, as we can see here. It's not, I wouldn't say ultra low, but it definitely is low. Okay. Ideally, we want it to be double that, ideally. But of course, yes, maybe it's not likely for somebody in their first week of trading, which is, again, it's not a bad thing. Everybody was a beginner trader at some point. Even somebody like me who has licenses and he studied and so on and so forth, and this is his industry, should we say? Even myself, I was a beginner at some point. Now let's look at what he's looking to earn and what he's risking per trade. Now, some people put stop losses and take profits. Some people don't use them, but they manually in their mind know where they're going to exit. And they're just, on their mobile and on the computer all day, keeping an eye on it. Either way is fine, okay? I'm not saying to people they should use one or the other. Either way is fine. But he's risking $15, okay, dollars per trade. And he's looking to earn $25 per trade. Okay, so it's a positive reward to risk ratio. He's not looking at an inverse reward to risk ratio, which he's looking to risk more than what he's looking to earn. Okay, that is something which is around, ladies and gentlemen. Keep that in mind. Some people do look at that, an inverse reward to risk ratio, but keep in mind it's only appropriate if you have a very high success rate. Other than that, it's definitely not a good idea. So we're going to look at, ladies and gentlemen, the trading plan after you start trading the first week and after this strategy. Also, I've got a spelling mistake here. I do apologize. I just noticed that. So based on 6 trades in a loss, his loss, ladies and gentlemen, is 150. Okay, so 25 times 6 because he has 6 trades in a loss. His profit is 60 because it's 4 trades times 15. So his loss at the end of the week is 90. Okay, he has an account of 1,000. So it's a loss, ladies and gentlemen, 9%. It's high. Okay, ideally you don't want that to be, you don't want it to be that high. But again, he's a beginner, and it's just an example. But this is a scenario which traditionally is seen within the market, okay? So based on this, what do we need to do in order for this trader to be profitable? Now, he cannot change very quickly his success rate. Yes, as he becomes more experienced, as he looks at more webinars and so on and so forth, his success rate will improve, hopefully. And generally speaking, of course, it's human nature, it definitely will improve. Nobody's going to be doing something for years and years and years, and it's never going to improve. If you're going to be watching football, as we said, playing football, and you keep on playing it for years, you definitely will get better. But in the meantime, what do we need to do to ensure he's going to become more profitable the week after? So let's say the week after, he's still going to open 10 trades. He's not changing that. his success rate is still the same. He's still a 40% success rate, ladies and gentlemen. The only thing he's doing is he's looking to earn more per trade that is in profit. Okay, so actually all of the 10 trades, his take profit has increased. It's now not 15, it's 35. Okay, and he's also looking to slightly, but only slightly, lower the risk per trade as well. So now, ladies and gentlemen, he, based on this, the success rate, 10 trades, and the new figures, each time his trade is in a profit, each time his trade is in a loss. Based on 35 times 4, because there's 4 trades in a profit, his profit is now 140. Based on 20 times 6, his loss is 120. So suddenly he's gone from 90 loss to a 20 profit. So this is just an example, by the way. Even though his success rate is the same, he's still unsuccessful as a trader in terms of determining how the market is going to move. Even though he's still opening the same amount of trades, he's made a slight change in order to ensure that he's profitable. Now, ladies and gentlemen, his success rate this week may change, okay? His success rate now may be 30%, his success rate now may be 60%, whatever it may be. So again, the week after, he will change this. And the week after that, he again will change this. But what you will notice is after about a month or 2 months, sometimes from the very first week, okay, for example, me, from the very first week, my success rate was always more or less the same. It's very steadily starting to increase. So for example, it stayed at 50% for a very long time, okay? And then slowly went to 52, 55, 60, 63, 66, 67, etc. Whereas some people see higher volatility, okay? What you can do is look at the past, 5 weeks and take an average success rate, okay? This is something you can do as well. What you definitely want to do, though, ladies and gentlemen, is avoid the scenario. And I've mentioned this here as well. Beginners tend to have a tendency to keep losing trades open and close trades that are in a profit very quickly, okay? So let's say this is a scenario where somebody's going to trade. He opened a trade here and he closed his trade here. Now, when you go back here and you want to make some changes, such as making the take profit further away, okay, before you do that, you go to the chart and you look at where you open the trade and where you close the trade. So I can see here, I opened the trade here and I closed the trade here. So I can see here that actually my take profit, let's say, was 0.20. Actually, I could have kept hold of my trade for longer. So for example, I may need my take profit to be 0.50. Guys, this is just an example. I may need it to be at 0.5% like this. I can see that if I kept the trade open, it would have been in a profit, and also the price after that kept moving in that direction. Okay, so I can see there's some leeway there as well, which is very important. So I've checked, ladies and gentlemen, I've not just changed my trading plan and my take profit, I've checked that if it was further away and I was trying to make a higher profit, that those 4 trades would have hit that profit, okay? The other thing for me to check is when I increase my risk, okay, it's actually going to increase my success rate. What do I mean by that, ladies and gentlemen? Let's actually go on to the next slide, and I'll show it to you. I'll draw it out for you. Let's say, for example, we're getting an impulse wave and then a decline. I open a buy here with a take profit here, okay? If, let's say my stop loss was here, okay? And the price did something like this, okay? And then it did something like this. So it wasn't a profitable trade. Why? Because it hit my stop loss. But I can see here that if I moved it slightly further away, it would have actually not hit my stop loss and it would have actually gone to my take. So you can look at increasing the risk as well. in order to increase your success rate. Okay, so if you're going to look to take your stop loss further away, you need to make sure you're doing this for a reason. If you're not going to increase your success rate, there's no point in increasing and taking your stop loss further away. If it does increase it, for example, by increasing it, it's going to take me from 40% to 55%, then it's something that I can take into consideration. So ladies and gentlemen, that brings us to the end of today's webinar. Hopefully people found it educational. Hopefully people found it informative as well. What I would like to say is, everybody, I wish to trade safe, trade responsibly. If you have any questions, feel free to ask questions now. You can, of course, also send us emails if you have questions as well. Send me an email, Michalis. This is my Michalis. Here's an email. These are my questions. If you can get back to me, of course, we'll get back to you as soon as possible. Within the day, always. People ask me for my name as well. So I'll actually go to the beginning of the webinar. Here we go. So ladies and gentlemen, my name is Michalis Efthymiou. Michalis is actually in Hebrew and in Greek. In English, it's Hebrew because it's from the Old Testament. In Hebrew, in English, is Michael. People can, of course, look me up here at HFM Markets. A lot of people ask me for my name, so I just wanted to very quickly apply to everybody. So I've got a question here, what's the best indicator to use? I'm not sure if you were here for the whole of the webinar, but today we very simply looked at 4 indicators. We looked at the 75 bar exponential moving average, the RSI, we looked at the Fibonacci. Here we've got moving averages again. And the 4th indication we looked at are these lines here, which are the Fibonacci lines. Okay, so I cannot say what is the best indicator, but what I will say is there's a reason why we put these indicators here today. Somebody said, what are the moving averages in 5 minutes? I'll confirm this to everybody. So on the 2-hour, ladies and gentlemen, this is a 75 bar EMA. So 75 is a period, and it's an EMA, so it's an exponential moving average. On the 5 minutes, we've got 2 moving averages, which is the red and the yellow. The red is an 18 bar simple moving average, and the yellow is an 8 exponential moving average. So hopefully that answers everybody's questions as well. I'll keep everything open for another minute before we end today's session. If anybody has questions, feel free to ask in the next minute. Otherwise, you can of course email us as well. We also had a lot of questions before the webinar. We had 6 questions before the webinar. I answered those before I got started. I won't go through those though. Suppose you are on the 3-hour time frame, what would be the 75 bar simple moving average? Keep in mind, on the 2-hour, it's an exponential moving average, so not a simple moving average, one that we've been looking at. So keep that in mind, okay? Now, in regards to, based on this setup, what would be on the 3-hour, what you need to do is you need to go to the 3-hour, you need to put the 75 bar, and you need to see how to change it to best fit the price characteristics, okay? So for example, if I look at the Dow Jones on the 3-hour, the 75 bar exponential moving average is quite accurate because there's not much of a difference between the 2 time frames. But if you, as you keep changing the time frames, at some point, the moving average will become inaccurate. you need to change it. How to change it and what you need to change it to, there's not an exact correct figure. And even if you're looking at the same asset, same time frame, but should we say the price characteristics are changing because it's a different market condition. For example, we saw that in COVID, and we've seen it this year for gold. Then again, you may need to change the period of the moving average. What you need to do is just keep changing it until you get to a pattern which fits and which is accurate. I've already done that for you for today, but only based on the 2 hour. Okay, in which case it's a 75 bar exponential. How can I go through this again? We will send you a recording in the next 24 hours. You can also go to the support team via the live chat, send them a message. Please can I have the recording, and they'll send it more quickly to you. Otherwise, you can just wait 24 hours, and of course, they will get back to you quicker. I've got another question here. What is the settings for the MACD? The MACD's got 3 settings actually. It's not like the RSI where it's just a period. So we have the fast DMA, which was on a period of 12. We also have the MACD SMA, which was actually on a period of 9. And then we had slow, which was on a period of 26. So it is 12, 9, 26 for the MACD. So let's end today's session. I can't see any more questions. Trade safe, trade responsibly. Thank you everybody for the great feedback. Thank you everybody for joining today's session. Hopefully we'll see you again very soon. I will have a live session on our YouTube channel tomorrow, and we will have another webinar as well next week as well. I think it's next Tuesday. If I'm not incorrect. I believe it's next Tuesday. In the meantime, goodbye and enjoy the rest of your evening. Take care, everybody.